Welcome to the Capitalmind podcast. My name is Shray and I'm here with our fund manager Anoop Vijaykumar, and we're here to talk about momentum, the momentum portfolio in our Capitalmind PMS. Anoop launched momentum about roughly 5 years ago in our PMS, and it's been quite a run. So if you've heard momentum, investing, and these words have come across your radar recently, we thought that we could do this episode of the podcast focusing on 5 years of momentum to explain to you, well, first, what's the difference between momentum and, say, more traditional fundamental style investing, how momentum actually works and how it figures out what to invest in, and whether we feel these last 5 years have been an aberration or momentum has much of a future going forward. So again, if these words or any of these sound interesting or intriguing to you, or you're already a customer and wondering what happens now after 5 years of pretty good returns, I think we'd like to hear what Anoop has to say. Anoop, 5 years ago, this was really interesting when you decided that it was time to launch a quantitative strategy in the PMS. And so my first question to you is, let's get some motivation going for people listening into this. How has momentum done over the last 5 years in our PMS?
Thanks, Shray. So we just finished 5 years in the adaptive momentum portfolio just a couple of days ago, and the returns have been fairly decent. Over 5 years, if you'd invested about 100 rupees, let's say in the Nifty, you would have a little over doubled your money. You would have about 216. In the NSE 500, you would have about 235, I believe. In the adaptive momentum portfolio, you would have about 353 from the 100 that you invested 5 years ago. So overall, that sort of translates to an annualized return of close to 29% per year compared to about 16 or 17% for the Nifty. So that obviously has worked out well. What's also been encouraging is that it's done that with roughly comparable volatility to the Nifty or the NSE 500 over that same time frame, which is over the last 5 years.
I think I particularly remember March 2020, where momentum had managed to sort of like delicately maneuver itself into a little more cash than other strategies, and it didn't fall as painfully. So that was definitely something.
So I'd like to take credit for it, but then it all comes down to the rules that we've kind of built into the system, which hopefully worked out the way that they were supposed to, where it progressively took us to cash when momentum in the market was dying out very quickly and quite sharply across the board. So yeah, that helped.
Fair. So you said rules. So assuming people who are listening to this just have a vague understanding of how momentum or this stuff works, could you explain what's the difference between, I think you call it traditional or fundamental style of investings, and these quantitative or style of investings like momentum?
So traditional, I call it that because that's the way in that most people know or are familiar with investing, which is start at a company level, look at, I would say maybe three things. One is look at the external environment to the company. There would be an external sort of a macroeconomic scenario at any given point in time. There would be interest rates. There would be ease of raising funds for any company. There would be the sector that the company operates in or the competition. So you would have a certain number of incumbents in that space. You would have a certain level of competition. That is, how profitable are companies in that space already? What is their level of influence with, let's say, their vendors or their suppliers or the people who supply raw materials, as well as what kind of options do the customers for that industry have when it comes to picking products or services within that industry. And then you've got the company itself and its internal capabilities, right? So you've got the strength of the management, their ability to execute, their ability to forecast or look into the future and decide where to allocate their resources and therefore build assets which are going to help you get the highest return on that investment capital. That sort of is the objective. And the third thing is kind of the moat. It's called that quite a bit. I would call it the sustainable competitive advantage, which is what is it that company has which others cannot easily replicate or buy. In the case of, let's say, Coke, it would be the brand name. In the case of, let's say, Amazon, it would be their distribution network. For somebody else, it might just be the amount of capital that they have in the bank. So all of those kind of come together to give you a sense of what that company's future cash flows are likely to look like. And then you discount that back to the present using their average cost of capital. And there you have what you call a fair value for that company. And then you compare that against what is the market currently valuing that company at. And if you've got a much higher fair value than what the market is willing to give at that point, you potentially buy that company and hope that in the future at some point, the market also realizes and agrees with your assessment, and that's where you make your return. So that's pretty much every fundamentally driven approach is about this. right? So quantitative kind of looks at it from a different lens. It looks at maybe reducing the hundreds or even thousands of potential inputs that you could consider down to a small set of more impactful metrics that drive future returns. So this could be, the return on capital that you're getting, the earnings or the price to book or the price to earnings or the price to cash flow, all of these variables being reduced down to a few which kind of matter towards predicting future return to an extent. And I mean, my analogy to it is how you could, potentially pick, let's say, a basketball team. The traditional way of doing it would be you would, follow players right through their school and high school years, look at how they performed in their school games, how many points did they score, what was their, mental toughness like when they were faced with tough situations. You would talk to their coaches, you would talk to their competitors, you would talk to their teammates to get a sense of, okay, what is their mental makeup like, what is their skill level like, and then finally they would, you would decide whether or not to draft them at the top level into your team. The quantitative way of doing this exact same thing would be finding information or data on successful NBA players going back, let's say 20, 30, 40 years, as long as you can, and then trying to figure out what is common across those 30 or 40 years of data. So you might find that the most successful players tend to be 6'4" and above, or they have a certain arm span, or they have a certain, height that they're able to jump, and a certain level of hand-eye coordination. So you would essentially codify those parameters, and then basis that you would say, well, somebody new who fits these parameters then becomes a potential, draft pick for your team. So it's really that's the way I would sort of differentiate between the fundamental and the quantitative way of investing.
But as soon as you said that, what came to mind, and I think you've talked about this, is when you look at quantitative investing and are trying to find these semi-predictive or predictive metrics, how do you make sure you don't just get some random correlation, like companies that begin with A, headquartered in Ahmedabad in the last decade? They may have done very well, but that's probably not a good strategy going forward in general. So how do you
completely? So there's I think two conditions that any quantitative investing framework needs to kind of meet to become a viable strategy for the future. One is obviously it has to be rigorously validated with data, which means data that goes back as far as you possibly can, not something that's based on the last year of data or the last couple of years of data, but something that you ideally want 50, 100 years of data where available. In the Indian markets, we are sort of limited to about 15 or 20 years of actual usable data. So for example, here's where you would test out something and say, what if we were to buy stocks at lows? How would such a strategy do? So we actually tested it out as part of our initial exploration, saying, what if you were to buy 20 stocks which were closest to their 52-week lows, hold them for a month, and then repeat that exercise over a period of 15 or 16 years. Intuitively, it seems like, that would do pretty well. You'd be buying stocks which are much cheaper than what their own prices used to be. Turns out not so well. I mean, the return, you'd end up with positive return, but that you'd do about half as well as just simply buying and holding the Nifty. And then what if we did the opposite? If you were to buy stocks which were at 52-week highs, everything else being the same. Turns out that would do significantly better than the buying at low strategy, but still would underperform the Nifty. So that is essentially about testing out with real data to say something that you feel should work, does it actually work in practice? So that's one aspect of it. And the other is more common sense. Like, is there an underlying economic rationale for that style of investing or for those set of rules to work? There's a famous example where in 1993 there were two analysts working at an investment firm. They published this report which basically looked at these multiple different macroeconomic metrics plotted against the S&P 500, looking for relationships which were predictive of where the S&P is going to be over the next month or quarter. The best relationship that they came up with was the Bangladesh butter production index, or the amount of butter that was being produced in Bangladesh was a great predictor of where the S&P was going to be in the next month. They obviously did that as a joke to highlight the fact that, just because two sets of data move together does not mean that one impacts the other. All right. So it's important to kind of, and he mentioned in a Forbes article 20 years later saying that he still gets calls asking for data on butter production in Bangladesh. So the point here is that there needs to be an underlying economic rationale, which I would just translate it to say common sense as to why something might or might not work. And both those conditions are kind of required for a quantitative system or a quantitative methodology to work.
Fair. Then coming to the strategy we're talking about, adaptive momentum as you've called it, what are the ingredients that go into it? What are the things you look at?
Well, in a nutshell, the core idea is very simple. It is that a stock that's been doing relatively well compared to the universe is likely to continue doing well for at least a little while longer. So as long as you're buying stocks and then holding them for a certain period of time, you are likely to do better than simply having bought and sold the index, bought and held the index rather. And that's the core idea. And of course, you can then add all kinds of nuances to it to say how far back do you look when you're trying to identify these stronger returning stocks? How long do you hold it? How do you even calculate past return? I mean, is it just about the absolute return between two dates? Is it the geometric mean of daily returns over the course of time? Is it a weighted average of the 12-month, 9 months, 6 months? So there's many different ways you could potentially define what you call return. You could adjust it for volatility. You could do all kinds of other adjustments to arrive at that metric. But the core idea is that a stock that's been doing reasonably well for a period of time is going to possibly continue to do that for a short period of time. And as long as you do that as a system continuously, you're likely to do reasonably well. And that's what we've found.
Fair. One question which someone could ask at this point is, so is this something that you figured out 5 years ago, or is this well known and you just implemented something?
Yeah, I wish. So momentum, funnily, has been one of the most rigorously studied principles in investing for probably the longest time. So not so much in India maybe, but at least in US markets and global markets, there's been research going back till the 80s where academics and practitioners both have tried to look at this phenomenon of buying, stocks which have been doing reasonably well. I think one of the seminal papers in this is a 93 paper by two professors, Sheridan and Titman, who were at UCLA at that time, I believe, who tested this idea of buying stocks which had done well over a certain period of time, in the past, and then holding it for a certain period of time and comparing that against simply having bought and held the index. And they found that pretty much every combination seemed to outperform the index. And then, that was followed up by many different papers by different practitioners, which essentially looked at, asset classes across markets and not just equities, looking at real estate, gold, bonds, debt, all of that. And they all found that momentum tended to persist across markets, across timeframes, across asset classes. And that's when, once you've read all that, is you realize, well, there is something here. There is one paper called Fact, Fiction and Momentum Investing that was published by the folks at AQR, which has this line that momentum has been validated over 2 centuries of data. And they had to mention that this is not a typo. We actually mean 212 years of US equity data, data in the UK markets going back to the Victorian age, data going back 40 or 50 years in other markets. So basically, it's been tested over long periods of time, and it turns out that it's persisted and it's been around for a very long time. So this is when we had started sort of exploring this whole line of thinking, and then we did our own study on Indian stocks back in 2018-19. We published a paper in 2020, which was the same thing. We looked back 15 years, looked at the universe of stocks listed on the NSE and picked the stocks which had done relatively better than the others, and then held them for different periods of time, let's say a month, a quarter, 6 months, a year. And all of that seemed to do better than just buying and holding the index. So that's where the core idea that, look, this is a solid investment philosophy kind of took root.
So we've experienced that it works and our customers can bear testament to that. But my question is, do you have a sense for the intuition as to why it works? As you said, that's also one of the reasons, things you look at for in a strategy. Like, do you have a sense for the underlying intuitions here?
So there's been a lot of academic research into trying to find reasons for it. And there are, I would say, at best guesses as to why it works. So one is, for example, is a frog in the pan hypothesis, wherein you've got a company and you have, let's say, consistent improvements happening fundamentally to the company. Things are improving for that company either because demand is improving or their costs are going down or they're just getting better. And as news kind of trickles out one bit at a time, we don't tend to react to it. So it's like the frog that's sitting in a pan of water that's being heated. It's not going to jump out because it doesn't notice those minor changes in temperature. And that's what happens in the stock market with stocks, where as good news keeps percolating in, people don't necessarily react to it, and the stock price might move up a little bit, but it won't jump up to the extent that is justified by the improvement in the underlying fundamentals. So a momentum strategy would then get in at some point and then be able to ride that increase, all of that increase till the point that is fully priced in. Another is a more fundamental disposition effect, which is where we are more likely to sell our losers, or rather sell our winners and hold on to our losers. I'm sorry. So basic being, we don't want to realize a loss, because a loss hurts twice as bad as a win. So we hold on to the stock that's down in the hope that it's going to come back up to our buying price, and then we'll get out. But we are okay with selling the ones that are up 20-30%, saying, I might as well pocket the gains and not risk losing those out. So as people keep selling their stocks, that kind of acts as a brake on the stock price, and the stock price then moves up slowly rather than suddenly, and that again allows a momentum strategy to kind of enter those stocks. So those are some, I would say, behavioral explanations for why momentum works. I would even say it's much more inherent to human behavior. I mean, if you think about you're on vacation, you're in an unknown city, you're trying to find a place to have dinner. As you walk down the street, which restaurant are you going to pick? The one that's completely empty, or the one that's got a fair bit of crowd and people waiting to get in? Or when we're buying online, are we likely to buy the product that has no reviews and ratings, or the one that has got like 20,000 reviews and ratings from people who already bought that product? Same way, I mean, if you're sent let's say an online petition to share, the one that we're likely to share is the one that already has 1 million shares on it, and not the one that has only a handful. So there's something much more fundamental to the way we behave. It's, we realize that there is something about the wisdom of crowds. By avoiding the empty restaurant, we are in a way potentially avoiding getting food poisoning, because we know something could potentially be wrong with that place. So the same thing kind of percolates into, I would say, investments decision making as well, as to we're more comfortable buying something that everyone else is buying at that period in time, or at least a few other people are buying at that period in time, which gives us, the comfort of the wisdom of crowds, and therefore, and if we believe that is inherent to human behavior, then I would like to think that momentum sort of has an underlying rationale right there, that there is safety in numbers, and that's what we kind of tend to, go towards, and that's why something like a momentum is likely not going to disappear in the next foreseeable future.
As you were saying that you've run momentum from like what, 5 to 800 crores or to, in dollars, like $1 million to $100 million approximately.
Mm-hmm.
And it's been 5 years. At points of time, you must have felt like a genius. At points, you must have felt terrible. What are some of the lessons you've learned? Because as you have yourself said, everyone's backtest or strategy always looks amazing. It's only that when the rubber hits the road that you realize the past doesn't exactly predict the future. So what have you learned?
So, I mean, lesson one is investing in momentum teaches you humility. One is that this assumption that somebody or the other always knows more than you do about a stock is a it's a fairly nuanced point, but not something a lot of people are comfortable with, right? I mean, ideally you want to find a company that everyone's missed and has no idea that it's worth a lot more than it's currently trading at, and then you get in at the bottom and then ride it all the way to the top. Momentum is literally the opposite in a way. It's counting on buying something that at least one set of people knows is doing better. As in, it might be sector specialists, it might be company insiders, it could be folks who just understand that space a lot better than you do, and they've gotten in, and that's what's resulted in the stock going up, and that's when a momentum investor gets in. Which means you have to be okay with the fact that I'm always going to rely on other people to make my investment decisions, and that's not very easy from an ego point of view. It's not easy to do. So that's definitely one lesson. The other is it's wrong a lot. I mean, we've looked at backtests as well as live data. Almost half of the stocks that you buy in the portfolio are going to exit at a loss. It is because it's very much a portfolio, a probabilistic approach, which means you're buying a bunch of stocks and then you're counting on some of them to do a really good job to give you a return, which means 50% are actually going down from the time that you buy them. They're going to quickly exit the portfolio. So the idea is to limit your losses because of the set of rules that you built in. But you're still going to be selling them at a loss, which again is very difficult for a lot of people to kind of stomach, because if you were a class topper used to getting 98 out of 100 or 99 out of 100, the idea that you're only 50% of your stock picks are going to result in gains is again not something that's easy to live with. So, that almost requires a different psychological makeup, I would say, to be able to stick with on a consistent basis. So that's a couple of lessons. So one other thing is that momentum casts a fairly wide net, in the sense that you never really know where your winners are going to be coming from. During one phase, your top performing stocks might be consumer goods stocks, and another it might be defense stocks, and another it might be lending companies or PSUs. And the fact is, you never really know where it's going to come from. So it's literally think of the idea of circle of competence, right? Most investors have a circle of competence, and then they stay within that when they're deciding what kind of stocks to buy, and that's the right way to do it. Momentum doesn't have its own circle of competence. It's literally relying on hundreds of different circles of competence to find the stocks. So it can go to any part of the market, be it in terms of sector or be it in terms of market cap. So at certain points, it will be overweight small cap PSUs more specifically, and at other times it might be in large cap lenders, let's say, and at other times somewhere in between. So it can literally skate to any part of the market where momentum is prevalent at any point in time, which I think makes it a fairly agile approach, as opposed to somebody who might be constrained by a certain set of industries or sectors or market caps. So that's one. The other is we found that unfortunately you can't quite figure out when it's not going to work or when it's going to work, conversely. So there have been phases in the last 5 years where it trailed the market. It trailed the benchmark for close to 18 months between sometime in 22 and late or early 2023. And the fact is, a fundamental investor could point to a stock or a company and say, well, they struggle with their order book, or they struggle with converting receivables to cash, or there was a slowdown in demand overall. So there are these very specific reasons you can ascribe to why a certain company in a fundamental portfolio didn't do well. You can't do that in momentum, right? You've bought a whole diverse set of stocks, and then none of them are doing a good job, and you won't have a clear reason. So you'll need to be okay with the fact that you can't really predict or tell when momentum is working or it's not working over a certain period of time. And it's only the discipline of staying invested that's going to get you the result at the end of it. So, same thing. It also means that a corollary is you can't really time it. I get this question so often, say, is now a good time to get into momentum? And my answer consistently, thankfully, has been, I don't know. I don't know if the fact that it's done close to nothing in the last 6 months, is that a sign that it's now going to start working? Or the fact that it's done 30% in the last 6 months, is that a sign that it's peaked? No. In both cases, I'd be wrong if I were to guess one way or the other. And which means that you can't really say, I'm going to wait till this and then I'm going to enter momentum, or I'm going to exit momentum at this time and I'm going to, stay in cash, or I'm going to allocate to a different strategy. That none of that has worked. The best performing investors would be those who kind of got in, consistently invested, stayed invested, obviously, and then added money when momentum was going nowhere during that sanguine period during the 2023, 22. So again, you can't really time momentum. Only thing I can say is, based on the backtest as well as live performance, is your probabilities of having done better than the index or the benchmark kind of go up the longer you hold, or the longer you stay invested. Like on a 1 year basis, there's almost a 1 in 3 chance that you're going to be behind the index. When you increase that holding period to 3 years, that comes down to somewhere around the 15% chance that you will still underperform. Once you increase to 5 years, then there is very little chance that you will have underperformed the index. So obviously, the only solution to not being able to time momentum would be to stay invested and therefore increase the chances that you're going to come out ahead.
Maybe when we first did it wasn't as common, but now there's a proliferation of momentum products across, everything. I mean, mutual funds, PMSs, and so on and so forth. Do you feel that with so many funds out there, momentum will just stop working? It'll get overexploited as a factor or as a contributing to returns?
So, I mean, that is a valid question, except that everything that we've come across in history in terms of research that's been done in markets which have much longer track records, the US, UK, going back 100 plus years, says that it's been around, it's always been around and it continues to be around. And not just in stocks in general, but also across other asset classes. It's been proven in other emerging markets, been proven in other developed markets in Europe and Germany. And we've seen it, it's been around in India for the 15, 20 years that we've been around. And it's done reasonably well over the 5 years with phases where it didn't do so well. So given all of that, I would say, and my belief that momentum is inherent to the way humans behave, wherein we are more comfortable doing what a lot of other people are doing, it tells me that, look, it's not going to just disappear. It might go away for periods of time, and then, but I think it's always going to make a comeback. And then, if you are consistently invested, that you're going to do pretty well overall.
One variant of this question I get is, look, this momentum stuff sounds pretty interesting, but surely if we do it on smaller stocks, like say just small cap stocks or maybe mid cap stocks, it'll be even more exciting. So your strategy would hopefully help me avoid the absolute terrible downturns, but it'll have such a wild ride on the way up that it'll be even more profitable than say the generic one you do or the general one you do. How do you react to that?
So it is, it's fair to think about trying to do momentum in specific segments of the market, but momentum in general tends to be agnostic of market cap, agnostic of sectors, is what we have seen, which means at some times all small caps are doing well, or a certain set of small caps are doing within the small cap universe. At some times it's all large caps. So a strategy that specifically constrains the universe that you're invested in my mind, is not going to do as well as a strategy that can potentially invest in any sector or any segment of the market. Which is why I would not really look at doing a small cap momentum strategy, because it's going to do well at a time that small caps in general are doing well. It's going to do, fantastically. But at the same time, it's also going to see those same drops when small caps then correct. And small caps are known to correct by 50-60% when they have their corrections, which means momentum being slightly higher beta, which means it might correct by even more than that. So I would not constrain myself to any specific segment of the market simply because I think overall your better returns come from having the entire universe available to you to pick from. My ideal strategy would be something that allows me to invest not just in India, but equity markets across the world. And not just equities, I would say even other asset classes. And then if you were to think of that as your universe and then just pick the securities, which is asset classes, countries that are at that time showing momentum, you would actually outperform pretty much any global investor at that point in time.
So that's going to be a bit hard in the PMS, but there are some things coming up in IFFC Gift City, so maybe we'll see if something works.
Fingers crossed.
Fingers crossed. I'd like to then end with the question, look, someone's listened in and has taken the time to hear you out till this point. They're like, look, Anoop, I get it. This is very attractive and you guys have run this for 5 years on real money. You have published audited statements. I get it. But I want to participate, but I'd like some advice on how I can hopefully avoid some of the pain or just get more out of this than say the average person who's participating in momentum. What advice can you share, or life lessons or anything?
So I'll answer that in two ways, right? So one is there are the way we see it, there's three sources of there are three kinds of edge you can have as an investor, which will give you superior returns, right? So one is informational. You know more than what other people do. So if you know more about a company, you're better able to value it, and therefore, if things are better than what other people think, you might be able to buy it, and then other people, when they realize it, you get your return. The other is analytical, which is how you work with the data that you have. So you might have all the financial information about the company, but you might have a way of interpreting the footnotes in the balance sheets and figure out that, hey, things are not as bad as it actually looks in the headline numbers, and therefore this company might be a buy. So it's basically the rigor that you put into the actual analysis of information that you have, but also what everyone else has, which might make you, better returns than the average person. And the third is behavioral, being able to do something that is really hard to do for most people and continue to do that consistently while other people might struggle and panic and get out. Then that's another source of superior return. So all superior return can be sort of boiled down to these three. It'll be a combination of these three. Momentum in my mind, and a lot of people try to think of it as it's all about the model. It's about how sophisticated it is and all those rules in place. To me, it is more behavioral and to a smaller extent analytical, which means your ability to know that this makes or this works over the long term, which means if I stay invested, there's going to be enough opportunities where I'm going to make great returns, which will mean that my overall outcome is going to be pretty good. And then doing it even when it's really hard is probably more important than how sophisticated the underlying model is. And so as long as you're doing that, then you're probably set. And, I'm just thinking back to the investors in our PMS who've done, pretty well over the last 3 to 5 years.
I was one of them. Yeah.
Exactly, right? So the ones who had the best IRRs or the, net returns were folks who, stayed invested through thick or thin. In fact, added money when momentum was trailing the index and was struggling and people were starting to question, hey, is it working? So there are clearly two kinds of investors. The ones who kind of said, who told me, hey, it stopped working. It's clearly not worked. Its 1 year return is now negative. It's way behind the Nifty. I'm going to move my money out into something else. And then there were those who were like, yeah, it's going to come back. I'm going to stay invested. I'm going to add some more money. So it's obviously the first kind or the second kind that have made pretty good returns overall. So if you have that, mental makeup of being able to give it 3 to 5 years and investing and then not questioning that or second guessing that the moment it doesn't seem to be working for a certain period of time, that's where your edge really lies in getting superior returns.
So it works because sometimes it doesn't.
Yeah.
It's insane. Right. Well, Anoop, 5 years are over and let's hope the next 5 are even better. Fingers crossed.
Fingers crossed again.
Well, everyone, thanks so much for listening. If you like what you hear, do visit capitalmind.in to learn more about how we think about markets and to learn more about our PMS and RA and other services. If you'd like to hear more episodes, visit capitalmind.in/podcast. And finally, do subscribe to this channel to get more alerts and see the latest on how we're thinking.